essentially, if you break it down, they don't have a long-term historical view, or for them history has ended, in the sense that the future, as they see it, will only move up and down in tandem with the Dow Jones Industrial Average, for example, or with the capitalist economy in general. For them, capitalist social relations of production are axiomatic, which is why when apparent prosperity turns into bankruptcy, almost overnight seemingly, in a very short space of time, they're stunned by it and don't really know what to do or say. Now, of course, Marxists don't have all the answers either. We don't know what the current capitalist economic crisis will bring, and we can't even make a detailed economic forecast. But we do have one advantage. Unlike the capitalist class and their ideologues, we have a historical worldview. We understand that society has moved in successive stages from one mode of production to the next, and that each mode of production has at first extended society's productive forces before exhausting its historical function and becoming a fetter to society's further development. The period of transition from the old, historically reactionary social relations to the new organisation of society is inevitably a period of acute crisis and struggle between contending classes. That is what we're experiencing today, and in truth, we have also been, to a greater or lesser extent, for the whole of last century. The current downturn is at bottom a classical crisis of overproduction, as Laura said, a recession. And these have occurred throughout capitalism's history, even during its progressive period, when capitalism was still taking society's productive forces forward prior to the 20th century. The current economic crisis was triggered by losses in the financial sector. However, it's essentially caused by a crisis of capital accumulation, by productive capital, just like every recession before it. That is a crisis in profit. But not all downturns are the same. Some are depressions, like that of the 1930s, which is the historical precedent increasingly being used as a reference point for today's crisis. And if you look at the graph, the Dow Jones Industrial Average, is not just a listing of industrial companies, but actually represents, it's a selection of the largest companies in the US, both industrial and non-industrial. The red line is its decline currently, well, for, as it says, the days after the 9th of October 2007, which was a peak. The black line is the Great Depression, going down roughly at the same rate. And I think if we could get a current one, that the red line would have actually gone down below the black line at a certain point, and maybe it's around there now or has come back up. I mean, it's very similar in terms of, that just shows share prices, but it's certainly an indication of what's happening. Now, I want to sketch an outline of the economic changes that have occurred in the 20th century so we can see our current situation in a concrete historical context. But before doing that, the key theoretical point that needs to be made to explain the crisis in any sort of satisfactory way is looking at Marx's theory of the tendency of the rate of profit to decline. For Marx, all value in the capitalist economy is created by human labour. Even natural resources need to be harvested and usually processed by humans or machines built by humans before that resource can be consumed. From there, Marx proceeds to demonstrate that the value of all commodities under capitalism, as opposed to their price, which is what they're sold for in the capitalist market, can go up and down, but their value, their intrinsic value, if you like, is determined by the amount of labour necessary to create that commodity, or the amount of labour necessary to create the machines that made the commodity or processed, transported, and so on, the amount of labour in total. Now, a profit is the appropriation by a capitalist of value created by human labour. That human labour is embodied in the commodity, giving it its value, which is sold by the capitalist for more than they paid the worker to make it. The problem for the capitalists is that because they are competing against each other, they're compelled to constantly reduce their costs. This leads them to get rid of workers if they can be replaced by machines or in any way gotten rid of, because that will lower their costs. and also to expand the volume of their production. Expanding volume is necessary because it reduces the unit cost of production. So a spoon, for example, can be produced more cheaply when you're making 1 million of them than if you're making 10. However, expanding production volume requires investing in more powerful or productive machines, thus reducing the relative quantity of human labour embodied in each of the commodities and reducing its actual value, and thereby reducing the amount of value that can be appropriated by the capitalist as a profit. That is the essence of a tendency of the rate of profits to decline. The decline doesn't manifest itself to the individual company. The individual company may enjoy increased profits. It may even enjoy an increased rate of profit because it can reduce production costs to below that of its competition and sell its products well above the cost of production. However, by doing this, what the company is doing, due to its superior technological position, for example, is actually appropriating value that has been created by other workers. However, the average rate of profit will tend to decline overall as a result of removing human labour from the production process, according to Marx. Now, I don't really understand the theory in a lot more detail than that. However, there is significant empirical evidence which points to the declining rate of profit in the capitalist economy. So if you look at both of these charts, the top is average growth rates of world capitalist economy, which is not the profit rates, but growth under capitalism is synonymous with profit because it doesn't grow unless they're making profit. And from the 60s through to the 90s, we've seen a decline in the growth rate steadily every single decade. And we have figures for the noughties or the current decade. And then US corporate rate of profit has also tended to decline as well. And that chart, the bottom one, US corporate profits, is also not quite current, and you find there would be a significant, very sharp decline if it continued another couple of years there into the current crisis. I think it only goes up to 2007 or 8. So yeah, the crisis really had only just started to be manifested in profits. Now, I'm not sure how related it is, but I mean, you look at Marx's theory of the rate of profit to decline when you remove human labour. One of the easiest ways to understand it is because when you totally remove human labour, no profit can be made, which is obvious because capitalists rely on workers to buy their goods and services, which robots can't do. Totally automate production, which we'll look at a bit later in the talk. Now, in the final years of the 19th century, the great powers completed the division of world amongst themselves and then proceeded to fight each other to secure more of it. This resulted in a series of inter-imperialist wars, such as the American-Spanish War in 1898, the Boer War, the Russian-Japanese War in 1904, and basically built up to a crescendo of a generalised inter-imperialist war from 1914 to 18. That's World War I, which was so-called war to end all wars, but of course it didn't. Except in Russia, where the war caused a proletarian revolution, World War I was followed by the so-called Roaring Twenties, i.e. a period of post-war capitalist reconstruction where the surviving capitalist firms could realise an increased rate of profit by investing in production. This was because the war wiped out some of their competition. Like a recession, it destroyed capital, but that boom was very short-lived. In 1929, the Wall Street stock market crash brought about the Great Depression, which in the United States stretched for 4 years until 1933 and saw national output shrink in that time by close to 30%. GDP, that is production, dropped by 8.6% in 1930 alone, by 6.4% in 31, and 13% drop in 1932. And then recovery in 1934 to 37 was followed by a relapse into recession. Unemployment went up to 25%, and output from US factories was halved. consumer prices fell by a quarter.